Hello class, welcome to this video. In this one, we are going to go over chapter 1, handout 2, and we are going to make the 3 basic financial statements that we need to learn here in chapter 1. Okay. So in this one, you're not going to be like on the previous one, you're not going to be able to see the handout actually. So hopefully you have it printed off. So I'm going to use a different screen here because I need a little bit more room to write. Use my flat frog here. Here's some information. Okay, so first we're talking about analysis of the transaction of the cavernous home. We use the following totals on December 31st. They give us some accounts and some totals. Prepare a balance sheet for cavernous home at December 31st. So remember to prepare a balance sheet. The first thing we need to do is put our headings on here. We have cavernous homes, company name, followed by the statement we're going to make, the balance sheet, and then we're going to date it. Remember, a balance sheet is a snapshot in time showing the accounting equation that assets equal liabilities plus equity. Since it is a snapshot in time, we only use a solid date there. We don't put a 4-period ending or anything, we just put December 31st. And then right underneath this, we're going to start by listing our assets. And we always start with our current assets. That's our heading out here. So we start looking through. The first one they give us is cash. Cash is a current asset. So I'm going to write cash out here in the amount of $3,200. Our next account that it gives us is accounts receivable, which is also a current asset. So I'm going to put it out here, accounts receivable, using some abbreviations. And the amount given for accounts receivable is $4,500. Next, we have notes payable. The payable, it is a liability, so we do not want to put it in our current asset section. We will skip over that for now. Then we have supplies. Supplies are something we're going to use to generate revenue. We expect to use them up within a year. It makes it a current asset. So we'll put supplies down. $8,100. Then we have common stock, which is part of equity. It's contributed capital. It's not going to be up in our current assets, and retained earnings, which is also part of an equity. Okay. I also noticed when we're going through here, when I kind of read all those off, that we do not have any non-current assets. There is no PP&E or intangibles to follow this. Okay, so when I add these up, then I'm just going to put total assets. Now, if I had PP&E and I had intangibles on this line right here, it would be total current assets when I added them up. And then I would go ahead and put my PP&E intangibles on there and then add them together to get my total assets, all 3 categories. But since I only have these 3 here, I'm just going to add them all at once and make the total assets $15,800. And I'm going to double underline that because that is a stopping point there for when we're doing our math. Then we need to put a heading on here for liabilities. Equity. And again, we start with current liabilities. Looking through here, we only have one liability. It is the note payable. It does not tell us whether it is current or whether it is long-term. Okay, so to properly designate this, whether it's a current or long-term, we would have to know when it's due. We're going to assume it's due in 6 months, 9 months, within a year. So we're going to make it a current liability. Notes payable goes out, and that is for $5,000. That is the only liability we have. again, just as the assets, if we had a long-term liability, instead of putting total liabilities here, we would put total current liabilities, add them together, and then list our long-term liabilities, add them to that to get the total liabilities. Without them, we just put them like this. Next, we have equity. Equity, if you recall, is made up of contributed capital and retained earnings. Most of the time, the contributed capital in a corporation is stock. When people buy their stock, when they issue it, that gives the corporation money to operate on. So our common stock here listed at 7,000. The second part of equity is retained earnings, which is accumulated net income minus dividends. The retained earnings amount they gave us was $3,800. And we can add those together to get our total equity. And then finally, our bottom line here. Our total liabilities and equity, we add our total liabilities plus our total equity. 15,800. And as you can see, we are in balance. Our total assets equals our total liabilities plus equity. Okay. And that is just a very simple one, not a lot of accounts listed there. Really easy one to get you started practicing making this financial statement. Okay, just to reiterate, we have our current assets. After that would have been PP&E and intangibles if we had any. We didn't. Okay, and we have current liabilities. After that would have been long-term liabilities if we had any, but we didn't. And then equity. Okay. We're going to get another practice on this on handout to read. All right, next statement. You're going to still start off with kind of the same heading. Oops. You realize the next question, the company name has changed. It's the Rutherford Company. Okay. And we're here, it asks us to make a single step and a multi-step. So I'm going to do the single step first. You don't need to write this up in the corner. I'm just noting that so you know that that's what I'm doing. I'm doing the single step. The next you put the statement name. You're doing an income statement. Remember, it is a period statement. So instead of having a date, it has a period. In this case, it's for the year ending December 31st. So that's what it tells you in the problem. And the following transactions for the year ending December 31st. Remember the single income statement. First, we're going to list our revenues. So we'll start going through. We had sales revenue, 65,000. That's our first one. So we put sales. $65,000. Insurance expense, not a revenue. Oh, we have interest income. So that is revenue. Remember, under the single step, we are listing all of our revenues in one spot. 3,000. Cost of goods sold is an expense. Salary expense is an expense. Income tax expense is an expense. Loss on disposal. Loss on disposal is kind of like an expense. Gains are kind of like revenue. Losses are kind of like expenses. Okay, if it was a gain, we would definitely put it here during the single step, but we're not. We can draw a line here, add them together. We'll get our total revenues of $68,900. Now we start listing our expenses. I'm just gonna go down the line here. We had insurance expense. $4,300. We had cost of goods sold. I'm gonna abbreviate that, just get used to it. I'm not even gonna put periods in there from now on, but it's cost of goods sold, or COGS. 28,800. Salaries expense, 22,500. Income tax expense, 2,400. And a loss on disposal of property, plant, and equipment of 1,200. You can add those all together, and we are going to get our total expenses. Of 59,200. Now we can take our total revenues minus our total expenses, gives to what we're looking for. This is our net income. 68,900 in revenues minus the 59,200 in expenses. Gets us a total net income of 9,700. And that is how you would create the simple income statement. Okay. This one is not used very often. It's good just to kind of get the process down, knowing that revenues are first, then expenses are second. The more common used is the multi-step income statement. So again, we have Rutherford Company. Income statement. For year ending December 31st. Okay. Again, here, we're going to start with our top line here of sales revenue. In this case, our sales revenue is still the same, $65,000. From our sales revenue, the first thing we do when we have sales, when we're doing a multi-step, is to take out the cost of goods sold, subtract out that expense right off the top. Cost of goods sold, 28,800. Something else to be aware of. You may not have to do this on your homework or when you're making the statements, but I wanted to introduce it to you now. Anytime you're writing a negative number in accounting terms, you just put parentheses around it. Okay, so I'm doing that there. So our sales revenue is 65. We're going to subtract out the cost of goods sold. That is going to give us our gross margin or our gross profit, whatever you would like to call it there. Goes by both names, be aware of that. In this case, then our gross margin comes out to 36,200. From here, we start taking out our operating expenses. Okay. So looking through here, we need insurance to operate. So we're going to make insurance an operating expense. And that was 4,300. Cost of goods sold, we already accounted for. Salaries expense, that is also an operating expense. And those are the only two we have. Loss from the sale of the equipment, that's not our normal operations. So we do not put that as an operating expense. An income tax expense never ever counts as an operating expense. It's always the last expense we're going to take off. Okay, so we add those two together. We get 26,800. Now we're going to do some more math, and this is going to become our operating income. Or income from operations. Okay. How you word it, those kind of mean the exact same thing. Next, we do our other. Interest income is not a normal course of operations. Interest never is, unless you're a bank, and that's how you normally make your money. But we're not going to be dealing with bank accounting here. So our interest income was 3,900. And then we had a loss on disposal, or something else that was other. And that loss was 1,200. Now we can take our 9,400 plus the 3,900 minus the 1,200 gives us 12,100. This is known as income before taxes. Then we take our income tax expense out, because this is the number that we're looking at, 12,100, and multiplying that by the tax rate, actually, to figure out our income tax expense. We'll get to that part. When we subtract that out, the number we get now becomes our net income of 9,700. And that is the net income that we were looking for. You can see it's a big difference. We get the same result. We get $9,700 in income, no matter which one we use. But when you're doing this multi-step here, you're getting a lot more information. You're communicating a much better information by using this multi-step income statement. Okay, we're getting this gross profit here. Okay, because a lot of times COGS is under manager's control. They can kind of control that when it comes to waste, theft, production, stuff like that. Operating expenses, not really in the manager's control, but they are needed in order to operate the business. So the operating income, 9,400. Okay, so how much did our normal course of business make us? Was 9,400. Interest income, we're not always going to have that. Okay, that's why it's broken down into the other. And we're not also going to have a loss on disposal of equipment. These are things that are peripheral that don't happen all the time. That's why they go into the other. Gets us our income before taxes. Then we take out our income tax expense to finally get to our net income. Okay, so if somebody's using this, they can say, Well, normally, they only made 9,400 in operating income, we could take the income tax expense out of that, and that's what we can expect them to make on a yearly basis. That could be what we're looking for, not that 9,700 because of all this peripheral stuff. That normally doesn't happen. All right, on the back side of handout 2 is our last one here. We have Parker Company. Okay, and we were going to make a retained earnings statement. We have Parker Company. We're going to call this statement of retained earnings. And it, just like the income statement, is labeled with a 4-year ending. Okay. You not want to just put the date. The only time the specific date goes on there is on the balance sheet, because that is a snapshot of time. So here, we start with our beginning retained earnings. And it tells us we had a balance of 35,000 on January 1st. From here, we add in whatever our net income was for the year. Doesn't tell us what our income is. It's something we got to figure out. We had 82,000 in revenue and 55,000 of expenses. And this kind of a question like this, you have to know how to calculate net income without actually making out a full income statement, and all the information is given to you there. Remember, revenues minus expenses equals net income. So we had net income of 27,000. From here, we less out any dividends that were paid. The dividends are returning money to the shareholders. About 8,000, so we're going to subtract that out. And that'll get us to the ending retained earnings, which we would transfer to the next balance sheet that we were making. So our new ending retained earnings amount would be 54,000. So there are some very simple examples with a lot of information given of just how we're going to communicate this information. All right, and that is it for handout 2. I hope that was helpful, and I will talk to you all again soon.